Oliver Pursche is joining us, too, of Bruderman Brothers, and Art Hogan of B. Riley. Art, are you buying? Are you seeing your clients calling and saying, OK, this looks to me like a buying opportunity?
Yeah, you know what we're hearing the most of is, hey, listen, all of technology has been for sale for the last couple of weeks. What's being thrown out here with the bathwater? You know, what's overdone? What's not related to social media? What's not related to some negative news coming out of Apple? So I think that the one thing we get calls like, hey, pick me something that's a winner in this wreckage here, this tech wreck, and let's start doing some work on that, because this market is very correlated on the way down, and everything trades with technology, regardless of whether there's been some impairment to the business model.
OK, with your trained eye, Art, what is a winner? Is it Apple? What are you saying? OK, this we would say.
Well, it's interesting. Now. So, yeah, I think on a multiple basis, Apple looks very attractive. I think that when you look at semiconductors in general, they've come under pressure with all of technology. The NVIDIA story took the whole group down, and then the Intel story today has taken the group down. I think if you look at a Marvell Enterprises, no relationship to what either one of those folks do, and yet it's down almost as much as those two names. I think you've got a great value there, embedded in the enterprise, embedded in the data center, and I think we've got a great new management team. So look at a Marvell. When you see all of semiconductors sell off, look at Marvell Enterprises.
OK, as we race toward that close, the Dow is now down 438 points. It's changing as I'm looking at the screen here. Oliver, what do you see as a real opportunity?
Well, our thesis that the global economy is still going to continue to grow at a robust pace holds true. Nothing has changed in the last couple of weeks. We took a look at some data, and since 1990, the VIX has traded below 10 only twice per year on average. In 2000, and that includes 17 times in 2017. So it's been abnormally low over history. So if you think about the global economy still growing rapidly, we're looking at some industrial companies that have sold off sharply on account of the fears over the trade war. You've got a push and pull, as Art was talking about, in the markets recently. And so we look at some of these companies like 3M, Boeing, Caterpillar, to name a few.
Which are all down. In fact, we've got industrials like Deere on the screen. Yeah. Boeing is lower by 2%. Yeah. Caterpillar's down by 2%. Phil, nobody is even, as you said, looking at treasuries and saying, oh, well, let's spike this yield at the moment. That I find interesting. The 10-year at 2.73% right now?
Right. And, you know, usually when you have a day like this and you have fear in the marketplace, you see a big jump in the VIX, you see around the treasuries, so they'd be buying them up like crazy as they're running away from the market. But they're not doing that right now. And that's mainly because I think a lot of the players are playing just the stock side. So when I see that, and I don't see that fear transfer into the other markets like it normally would, then I look at at least one of them with some skepticism. And I look at the stock market with some skepticism today that this overdone selling on these headlines after the weekend, you know, it seemed to be just based on fear and not reality. I think the true test, Liz, is going to be when the foreign traders come back overnight, when you start seeing Europe come back into the market and China and Asia, how they react to our sell-off today is going to be the key. So I think you have to wait at least 24 hours to get a real feel for it.
The British market, the FTSE 100, has just announced it's had its worst quarter since 2011. Is it spreading? Who knows? I want to know what the traders are thinking. Can we go back to Ashley Webster? He's on the floor of the New York Stock Exchange. 3 minutes to go, Ash.
Yeah, you know, general consensus here, I believe, is all of this has been overdone today. We have come back almost 300 points on the Dow, but generally the sense is there's a bit of a data gap right now. A lot of investors focusing on the headlines. Yes, there is concern about more regulation and changing the business model of the big tech stocks, perhaps certainly Facebook. Yes, a trade war with China, although that's really kind of on the back burner. They come back with $3 billion worth, while we say 50 to 60 billion. So really the response from China has been a little muted. But bottom line is that data gap. We do get the big jobs report on Friday. We get the earnings season just around the corner. Those could actually be bright spots for these markets to show that the economy is going well and we're on solid ground.
Art, we've got 2 minutes left before the closing bell. Earnings season is coming. It's not supposed to be that bad. 17% for the S&P overall year over year. We need to broaden this picture and say things are pretty strong still, right?
Yeah, Liz, that's a great point. I think when we get in this momentum sell-off like we've seen, you know, in technology and the financial sector, it starts as we get worried about protectionism and China and NAFTA. We forget about the solid fundamental backdrop that we have right now. Earnings is going to be one piece of that. We'll start hearing that in 2 weeks. But the economic data has continued to improve. So the ISM manufacturing number came in, very solid report. I think that the fundamental backdrop and the multiples that the S&P 500 has contracted to, we're trading less than 16.5 times next year's earnings. I think, compared to where we were at 18.5 times in December, we're just in a better place with a stronger economy and better earnings growth.
Oliver?
Well, the only thing I would add is, look, 17.3% earnings growth is a lofty expectation. And the higher the expectations are, the greater the risk for disappointment. So investors do want to be cautious here. And I think that you don't jump into the sell-off. This isn't buy on the dip anymore like we've seen over the last few years. It's something where you pay attention to the fundamentals and make sure that your investment thesis holds true. And if it does, then yes, this is a great entry point for several companies over the next few years.